So everybody wants a perfect strategy to day trade. Now, they genuinely gravitate towards mechanical trading. Now, there's nothing wrong with mechanical trading, but it is fraught with danger.
Really?
Really?
Because you cannot look into the chart and read the conditions. You're doing X marks the spot. Well, unfortunately, X marks the spot doesn't really work in this industry. You've still got to be able to read conditions to a certain degree. So what I'm going to do is I'm going to try and put some meat on the bones to something I said in the last video. Now, this is a bonus video because I'm going on holiday this weekend. Winky's gone off shopping. There's a shocker. And I'm left on my own. I thought, well, I'll just quickly do this before I head off. So, what's the crux? Well, kicking around on TikTok and Facebook and everything is a one called the daily box strategy. Is it good?
Fuck no!
But I'll show you how it works. And then I'll show you a version of the London breakout system, which is kind of a box breakout. And see which one you like. Now, the way it works for the daily breakout is you will see the day's prior candle on a daily. And you would put a line at the bottom, just like so. We'll just turn it black so that we can see it. One at the top, just like so. And then one in the middle. I'll just eyeball it, roughly there. Now, the theory is this. When the price is at the top, you only sell it. When the price is at the bottom, you only buy it. And when it's at the middle, you do nothing. And the idea is you enter the trade and you hold it to the other side. That's the bit that's a little bit scary, because that means you've got to change an entire dynamic.
Who'd be stupid enough to do that?
Justify, stupid.
In other words, going from a top to the bottom, carrying a whole ATR. That's pretty dangerous, okay? So if you target effectively, then you might be in with a shot. But if you're trying to hold that all the way to here, you've got a real problem. Certainly if you haven't seen the upper trend. Well, there you go. How would you know that's coming to here? You wouldn't, all right? So let's have a quick look at this one, shall we? So you would start this. So if we take it down onto the 5-minute chart, which is what they suggest. So we'll just run this down. So through the day, you'd probably be starting in and around 8 o'clock. So that would be here. So that would be there. Okay. It's touch the top, looking to sell. So from 8 o'clock, it would be, we'll put this in a green dotted line. It would be a break of that candle, which would be there. Now, they never mention anything about stops or anything like that. So what I would look at is the last swing high or above the level. Well, as you can see, it poked through. So the last swing high is probably better. So in this scenario, that would be here, up there. So your stop wants to be a minimum of that point. So that's the range for what you're looking for, which is there. So if we drop the range in, so that would be like 17 pips to come down. And what would it do? Well, it fails. All right. Would have stopped you out. All right. Now, that was a basic criteria based on what they're saying. Definitely would have caught you out. And that was your first trade of the day. Right, okay. Well, let's take it into another day and we'll see if it works. So we'll clean all of this down. So that one would have failed. What about this one? Well, we'll try this one, shall we? So we'll do this and then I'll show you a different way. Okay. And we'll eyeball it again. just roughly there. Just put a black line on just so I can see where I'm going with it. Okay, so that would be, so we'll be looking for 8 o'clock on the 30th is what we're looking for. 8 o'clock on the 30th. So that would be starting here. Right, so it's neither at the top or the bottom. It gets to the top here. Okay, so you'll be looking for the break of the candle. So your entry point would be the break of that. Okay, which is there. The last swing high was here, and it went and took you out straight away. Now, you might consider that to be tight. So let's have a little look at it, see what it is. Still about 12 pips, which on cable is pretty sizable. Okay, and if you go back in time, you haven't got anything to work to. So that was the swing high, down it came, and then it would have wiped you out. So again, this hasn't really worked.
It's broken, Mom. Mom, it's broken.
So let's look at it from a different point of view, using the same sort of days and criteria, etc., etc. I agree to looking at a daily sentiment to get an idea of what's going on. But if you're looking for basic trades, here's a very, very simple way to do it.
Oh, here we go.
Now, the first thing you would do is come to your daily and you would establish what is the average true range. Now, the average true range is an average over the last few days. Now, you can go whatever you want, the last 5, 10, 14. I just leave standard settings 14. So it's currently running at 83 pips a day as an average true range. Now, in order to put that into common sense, if you work on what's called a base, like a B trade, a base trade, and I put in 83 there, it'll tell me roughly how many pips it'll move per wave. Well, it's telling me it's 9. Okay. Now, what that is, it's a third of a third. Okay, so you divide the daily ATR by 3 and then divide it by 3 again. And what that'll be is the waves that you see in and out the markets, that's roughly what they are, and it gives you a baseline to work to. So I know when I'm going to market, I'm looking for 9 pips. That's my base trade. Okay. So take this down to hourly. Right, you can actually do it on a 5-minute or a 15, depends on what you choose. Now, if you're doing it through the open, I wouldn't recommend that. I would say 15-minute. But as you go into the day, maybe drop it into 5 or just leave 15 as is. It's up to you. Right? But the rule of thumb is this. So first of all, you need to establish what your range is. So I'm just going to take that indicator off for now. And what we're going to do is we're going to go and we're going to find the opening range. Now, the opening range is the first hour. So if the open's 8 o'clock, it's 8 through 9. If it's sort of New York time and you're in the UK like I am, opens at 2:30, it's 2:30 through 3:30. Okay? So, first of all, we find the opening range. So I need to know where 9 o'clock is. So that would be here. And it opened at 8 o'clock, which is there. So just put it to either side of those candles. So now you can see what's called the opening range. And you'll be able to see the high and the low. Okay. So what I'm going to do is I'm just going to draw a rectangle straight through it. Okay. There we are. So what we're looking for now is the break of the high or the low. However, if you looked at this on its own, how do you know which one's the strongest?
Fuck if I know.
So, if you put on a Bollinger Band and then you dropped it out to the hour, okay, should have maybe done this on the hourly, so I'll have to just quickly find 8 o'clock. So that would be in and around this area here. Because the thing with this platform is if you draw low, it doesn't show high, but if you draw high, it'll show low. So I'll do that when I do the next example, I'll show you. So started here. There is the 8 o'clock candle right there, the red one. There is the 9 o'clock candle. What you're looking for is above the moving average. Now this is a 20 moving average, which is well suited to the hour because there's approximately sort of, well, it's 20, it's pretty close to 24 hours. It's above, and you also want it either inside the Bollinger Band, or if it's on the outside the Bollinger Band wants to be flaring out, all right? So it's inside, above. The only thing we're looking for is for it to break to the long side, okay? So that eliminates part of what you're looking for. So if you take this back to 5 minutes and we find this, we know we're looking for a break to the long side of this box. Well, that happened here, right there. Okay, so draw a line on, bish bash bosh. So there's the break. What we're looking for is the first close above it. Well, we're at 12:15, so 5 minutes is fine. 15 minutes in the first hour sort of thing. Right, so that would be your entry point. Where are you wrong? Well, you're wrong if it breaks the range at the other side. Well, you're wrong down here. So measuring tool from there to there, 18 pips. You will easily get 9 pips out of this, which is your base trade. Okay, easily. Right. So what you would do is, well, 9 pips is halfway. You will put your 9 pips in as your first take profit. And you can do this one of two ways. You can either take your profit when it hits 9 pips and then pull your stop in and let the other 50% go, or open 2 trades at once. So if you're on a pounder point, 250p trades, first one will close out naturally. Pull the stop in from here, because your stop is the other side of the range. And then just move it every 9 pips. So every time that went to 9 pips, so when it gets up here, your stop would go from there to there. Put another 9 pips in, it would move to the top of the box, and then eventually stop you out. That's an easy way to do it. So that one was fine. Right, let's do another example. Hour. So what we'll do is we'll just take this back to the day prior. So that'll be Thursday the 30th. So just quickly find the range. Just switch the Bollinger Band off for now. Well, actually, I don't need to. So 8 o'clock. So if I draw a black line here, just like so, black line above it, all right, so there's our range. That's what we are working on, this bit, that bit there. We can see it's above the moving average and it's inside the Bollinger Band. That's good. We can live with that. We're now looking for closes above that line. Okay. Take it down into 5 or 15 minutes, whatever you want. So we'll take this back. Just need to scroll this back a little bit, guys. Right. So 7 o'clock. So we need to mark this at 9 o'clock. So that's that candle there. Same principle. You can do either a 15-minute close or a 5-minute close. You know, so it doesn't really matter. So if you're doing a 15-minute close, it would be that. Fine, yeah, three candles, so that would be the high. All right, so that's the break. So I'm going to use that because it's the worst case scenario, which is there. Cross. Green, just like so. You need to establish your main range so you can see whether it is worth it. So the first thing is you're looking for your base trade of 9 pips. So your first target would be there. Okay. Let it run up to there. So that's your first target. But bear in mind you want a runner. But you always want to be paid for your money as well. Okay. Take that down to where the stop is going to be. So ideally you want it to get up to there for the running trade. Well, it did it quite easily. Did it go into the stop? No. Now, there are different ways you can do this. You can scale into this as well by following the price. Now, the way you would follow the price is, as that came down, you just move the price till it takes you in. Well, that means that would give you the price here to go in, which would have made the stop less and made the target easier. Now, as long as it stays above the middle section of the range, you're still in the criteria that this is good to the upper side that you've already decided on. When it goes through the bottom of the range, then you're thinking, I could be wrong. And if you're already triggered in, well, that's your signal to say, I need to get out of this at my first opportunity. Now, you can either kill it because you're using a mental stop, or if it bounces and it gets you into sort of a profit, just kill the trade and then reassess it. All these different little bits and pieces, they're all there. On something that tight, I would just let it run right through and I'll live and die by the situation. But what I would do is I would scale into it to get better pricing to get up.
Holy fuck.
Now that is a very simple, methodical way of trading. Okay. Now that's a breakout system based on the opening range. Now it works on the majors. So it's things like cable, Eurodollar, USJPY. These are the things that this works very well on. But the secret sauce to it is you need the opening range first and then just use a moving average to decide whether you're only looking to go long or only looking to go short. If you go into this just on a, well, it's at the top, I'm going to buy it, or I'm going to sell it, and at the bottom, I'll buy it.
You were literally too stupid to insult.
Where's the reading of the chart? How do you figure out where your stops and everything are? It's all like that. At least this way, it's reasonably mechanical and it has a thought process in it. The next part of it is how you conduct yourself to the market. Now that bit takes a lot of work and you'll see that in other videos on the channel. Money management comes into it, scaling comes into it, how to escape a bad trade. All of these different elements fall into trading. But when you're looking at a mechanical system, none of that's taken into account. They're looking purely at an entry point when really you should be looking at the big picture. What is the market doing as a trend? What is the market's ATR? What's it capable of doing? That will always be your first profit. Always. So if it says it's 9, your first take profit is 9. Why? Because it's already told you that's what it can do.
Now you're asking the right question, shitstick.
This is what research and homework's all about. So look around the channel. You'll see plenty of videos on that. I'm very easy found. Go on the website, scruffytrader.com. I answer everybody. Drop into the WhatsApp. It's all free. You see what I'm up to during the day and you'll see how to get into the Discords, etc. And that's it, guys. So mess around with it. Tell me your thoughts. And hopefully we'll speak on the next one.